Hi, this is Cayden Chang from VIA Value Investing Academy. So I'm standing in one of the most dangerous places in Tokyo, and this place is called Kabukicho. So here am I answering one of the most common questions that people ask about investing. And the question is, when can I get money if I started to invest immediately? In fact, the answer to the question is quite simple. What you need to do is you just need to buy a company that pays a dividend. For example, if you invest in the companies that pays a dividend, such as any big cap companies or blue chip companies in Singapore, so what they do is every single year they will pay you a dividends 4 times per year. So right now the question is, if you start investing in such companies, when will you get paid? So first thing, you have to understand this term called the ex-dividend dates. It simply means that the moment you invest in such a company, there will be times when the companies declare that they're going to pay dividend. And such date is called the declaration date. So declaration date is the date where the company announced that they're going to pay dividend. So now the question is, assuming that the company has declared that they're going to pay dividend, when is the exact date that you need to buy so that from that point onwards you're able to collect dividend from this company? So let's say the ex-dividend date is today. So what you need to do is you just need to buy the company a day before the ex-dividend date. In other words, you will buy it yesterday. So the moment you are able to buy the stocks yesterday, and even if you sell the stocks today, which is on the ex-dividend date itself, you will get paid dividends by the company. So sometimes friends will ask me, if investing is so simple, what I need to do is I just need to buy the stock at least 1 day before the ex-dividend date. And if that's the case, wouldn't that just be making money, just collecting dividends throughout the entire year? It's not really that simple. It's because the moment the company declares they're going to pay dividend on the declaration date, usually the share price will go up all the way until at least a day before the ex-dividend date. Which means that if you buy the stock just for the sake of dividend on a day before the ex-dividend day, the price that you're going to pay usually will be very high. And subsequently, once the company's paid the dividend, usually the share price is going to go down. So what does it mean? It simply means that the dividend that you collect most likely is not able to cover the price that you pay at a high price and then you sell at a low price. Which means that if you buy stocks just before they pay dividend and then you sell it after that, now it's not going to be a very bright idea. Why? Remember, the share price that you're going to buy is going to be on high side before they pay dividend, and subsequently, once dividend is paid, the share price is going to be on the low side. So in fact, what you're doing is actually you're buying high and then you're going to sell low. So you're going to have some loss. And the losses that you're going to take most likely is unable to cover that dividends that you collected, which means that it's not really a very useful tactic. So this is Cayden Chang from VIA answering your questions about investing in Kabukicho. Thank you, I shall see you soon. Bye.